Good afternoon, everyone. Happy weekend to you and happy weekend to us because we have you here. So welcome to our webinar. I'm Naman. I'm going to be your host today. And I introduced you to a webinar which is hosted by EduFund in collaboration with Ditto by FinShots. And I will take this minute to introduce our panelists for today, along with the organizations that we represent. So Ditto is a new age insurance advisory platform that simplifies insurance products and with which you can understand your policy, get your answers to your questions, and buy insurance all under the same roof. Our hope is to build a company where insurance products can be sold without misleading customers, without spamming them, and treating them with dignity. EduFund likes to pride itself in being the authors of the India Chalega movement. We've taken it upon ourselves to better the financial journey for savings for your children's college. It is our dream to help every Indian parent afford their child's dream college fees and costs. And we're trying to make this possible through helping parents save towards it smartly and get the funding whenever it is that the time is to send your child to college. I would like to introduce Shahid Takira, who is the co-founder of Ditto and FinShots. He will be our first panelist for the day. He is a writer entrepreneur from Mangalore and has graduated with a master's in business administration from IIM Ahmedabad. He currently oversees all content initiatives at FinShots, which is at this point India's largest newsletter, and Ditto, which is, like I said, an insurance advisory platform that helps people make better decisions when buying your protection products. Next panelist for our day is Arindam, who is EduFund's co-founder and chief information officer. He has worked for 15 plus years now in the financial sector and has been exposed to both the Indian and the US market. He completed his bachelor's in mathematics from Indiana University and his master's in finance from Princeton University. And we like to celebrate his entrepreneurial spirit, in which we believe is a result of his desire to empower Indian parents and transform the academic system to facilitate equal higher education opportunities for all students, irrespective of their financial background. The rising cost of lifestyle and just your basic amenities is a reality right now, which includes healthcare, education, and living costs. In today's webinar, we will be talking about two important pillars of financial security. One, investing, and second is insurance. Our panelists today will help you understand how to choose insurance policies for your family and how you can start investing to save for the education of your children. There will also be a question and answer session at the end where Shahid and Arindam will address your questions. And with that, I would now like to open the floor to our speaker and first invite Shahid.
Thanks, Naman, for that kind introduction. Obviously, as the whole idea here is to talk about investing and insurance together. But might I take sort of a small diversion and explain why most people don't think about insurance the right way? Now, when I say that insurance is probably the basic foundation pillar of your investment plan, most people get the idea that I'm probably asking them to buy a traditional endowment ULIP plan, which mixes your investment component and then you have the insurance component together. Right? It's a product where you pay your annual premiums for, let's say, 5 or 10 years, and then you hope that after 15 or 20 years you get a corpus that can help you, I don't know, for your retirement, for your children's future, alongside the fact that during those years you also get life protection. That is to say, that if something happens to you, your child, your spouse, your nominees effectively get a large lump sum payment, so that they don't have to worry about you worry about tiding over your finances in your absence. The problem with this idea, the problem with this whole logic is that insurance and investment products, when you combine them together, they don't do either of those things, right? So for instance, you don't get the benefits of investments, nor do you get the benefit of insurance. So today's session, and I know I took a small diversion, is largely going to be about pure protection products, which is to say that you pay a premium, you pay a fee every year, every month, depending on how you structure the contract. And at the end of the term, if something happens to you during this term, the insurance company will pay out a sum of money so that you don't have to worry about the expenses that you may incur in the process. Now, that could happen because something happens to you, your life, or if there's a medical emergency, right? So when people should think about insurance, they should primarily think about protection, right? Protecting your downside. Maybe talk about effectively the two main categories within insurance. So health and term insurance, that's what we're going to talk about. But let's start with health. Now, I'm sure that most people who are probably listening to this have dealt with health insurance and probably have one of two opinions. Yeah, one is that they have a policy, they probably are not very happy with it because they've heard that insurance companies don't pay out when you actually make a claim, or they've heard that health insurance policies are practically useless because anyway you're not going to get the money, so why waste paying the premiums? The problem with this logic is that it's not that health insurance companies don't pay out the money. It's just that most people who sign off on an insurance contract are party to an unequal arrangement. Now, think about it for a moment. If any of you at any point in time have probably bought health insurance, right? You probably found out that you haven't read any of the terms of the contract. Right? Imagine doing that with some other contract. Let's suppose you want to have a rental agreement in place. Do you think that you will actually sign off on the rental agreement without actually reading the document, even at least glancing through the document at least once? It sounds preposterous, but yet when we buy health insurance products, that's precisely what we do. We don't read the contract. We don't even know the name of the policy. And most people don't even know what company it is, right? Because they're trusting the agent. And obviously, if you sign off on such an unequal contract, you are going to find out that you will be shortchanged when you actually have to make a claim. The second problem with people thinking about health insurance is that they often think about the use cases that are most apparent in their lives, right? For instance, just to give you an example, when we ask people, hey, why are you buying health insurance? They say things like, oh, listen, recently I had malaria and I was hospitalized for 3 or 4 days, and then I had to spend 60,000. That was a bad experience. So now I want a health insurance product that will actually pay off those expenses, right? That's kind of what you hear. But again, there's sort of a small problem with this assessment. And the problem is, when you're thinking about health, look, if you're paying 60,000 and you don't have health insurance, that's going to be taxing. Like, let's be sure, like it's not going to be pleasant to shell out 60,000 just like that. But that's money you can still afford. Most people that are probably listening to this will probably be able to put together something like 60,000. What they won't be able to do is to put up 8 lakhs, for instance, because they found a tumor in your brain. Now, I'm sorry for the graphic depiction, but effectively, what I'm alluding to is this. If there is some black swan event, and by that I mean some extraordinary event where you're expected to pay a large sum of money that you simply can't afford, what it does to you is that it pulls you from wherever you are in the income hierarchy, right? You could be in the middle class, you could be in the upper middle class, but irrespective of where you are, unless you're really rich with generational wealth, what happens is it will pull you down into the throngs of poverty. More often than not, people who are extremely well off to do in that they don't have to worry about how they're going to put a meal on their plate the next month. These people, when they see that they have to pay something like 8 or 10 lakhs because of some extraordinary health event, they're effectively ruined for life. I mean, oftentimes, even if you have like a savings corpus, you will run through it in just a matter of weeks or months, and then you'll be back to square zero. It's almost like you have to build up your investment plan, or you have to plan for your children's future, or you have to plan for your spouse's future, all from the beginning, just because you didn't have protection for this one extraordinary event. Now, for most people, it won't happen. Luckily, we will probably lead very happy lives. It will never, we hope that it never comes to that. But if it does, you need some protection. The analogous example that I can think of is probably people who buy fire extinguishers. Like, you don't buy a fire extinguisher thinking that, oh, listen, if something happens, there's going to be a fire in my house. That's not what you're thinking. What you're thinking is, if there were a fire, which is extremely unlikely, I don't want to be caught in a spot where my whole house burns down and I have nothing left. I want to be able to nip it at the bud. And so the whole idea of health insurance, and for people listening to this webinar, I just want you to think about this situation, right? You're planning for your kids' futures. You're probably saving, you're probably building an investment plan. But if you don't protect your downside, which is to say that these asymmetric risks, right? These extraordinary events that can append your whole life together, it can be deeply problematic, right? So it can completely cripple you. So one of my most humble suggestions, whoever is planning a financial, let's say, who putting together a financial plan, is to first figure out how you're going to protect for these events. What kind of health insurance products are you going to buy? And how are you going to make sure that when you do buy it, you don't make stupid decisions? And sorry for using the word stupid, but if you're signing off on a contract without actually reading the terms, that's effectively what it is. It effectively boils down to that element, right? You just don't know what's in your contract. So bottom line on health insurance, for anybody who's looking to buy the products, three things. One, almost always ask yourself this question: what is that downside risk that I'm willing, that I'm trying to protect for? Can I pay 10 lakhs out of the blue? Something were to come. Is that something that I can put together? If I can't, then I probably need a health insurance plan that will protect myself from those situations. The second thing is, if you are buying an insurance plan, you have to make an effort to understand at least the bare minimums. What are those bare minimums? The first thing is, know that insurance companies don't cover everything, right? And when they don't cover everything, you have to ask yourself, how can I optimize for the outcomes where they do cover something, right? Now, one thing that we've seen often with people is that they buy an insurance plan and they quickly figure out that you know what, I don't have to talk about my pre-existing conditions. I can hide it. How will the insurance company ever find out about this? But please, believe me when I say this, insurance companies almost always find out if you're hiding things from them. So small things like these, where you're optimizing for outcomes by being honest, by knowing that insurance companies don't cover everything, what are those things that they don't cover, and also knowing how to optimize outcomes when you have to make a claim, making sure that you go to a network hospital, etc. So bottom line, if you are planning for your children's future, I urge you to consider buying a good health insurance plan, not just for yourself, but also for your family, so that you don't have to risk those extreme events. The second aspect is term insurance. And perhaps here, more often than not, people have some life insurance product with them, right? Somebody sold them a product, maybe some agent who's looking to reach his commission targets. It's probably sold a ULIP or an endowment plan or something of that sort. Now, please know this much. Whenever you're signing off on an endowment plan or a ULIP, etc., you are not getting the benefits of investment and insurance together, right? That's not what happens. In fact, if anything, I could say that you're not getting the benefits of insurance, nor do you get the benefits of investments. That is effectively how it is structured. Because the simple reason is this: when you pay 100 rupees in premiums to an insurance company and hoping that they will invest that money, they will immediately set aside 10 rupees or 15 rupees out of that 100 rupees to protect your life, to offer you life cover. That is to say, if something happens to you, they'll actually offer you, say, some 10 lakhs or 15 lakhs, so that, in your absence, your family has some money. The second thing is that the amount that's remaining after excluding all the charges, right? So out of 115 is gone, then maybe they have 2 rupees, 3 rupees, 4 rupees for other charges. And finally, they only invest about 60, 70 rupees. I'm just giving an example, a ballpark figure. But my point is, if they're investing 70 rupees, you're not going to get a lot of compounding benefits because you invested originally 100 rupees. So my suggestion here is to not look at life insurance as an investment product, but again, to look at it as a pure protection product, that is, buy a term insurance plan. If something happens to you, or basically whoever is being insured here, then your family should get a sum, let's say something like 1 crore, so that they don't have to worry about the next 10, 15 years in your absence. We're not talking about just 1 year, because it's very hard for people to put together their life in order whenever there's a loss of a critical bread earner, right? I mean, it's very hard for them to come together and say, okay, fine, I'm going to tide over this 1 year and then I'll start working, etc. No, that's extremely hard. So the better approach is to actually buy an insurance product, a pure term insurance product, where you get a large payout, something like a crore, 1.5 crore, 2 crore, depending on your income, so that in your absence, your family will always have that sum, right? To tide over the next 10, 15 years, not just 1 or 2 years. The second thing is that when people buy term insurance products, they're almost always buying products in the hope that they'll get some money back. But any insurance product, that's pure protection product, doesn't offer you money back. Money back is never a good thing. In fact, anytime somebody promises you money back, what they're saying is, you give us premiums, we'll take a small portion of it, set it aside, maybe it'll grow at 3-4%, and then we'll return that money back to you. You'll probably be well served to do a fixed deposit as opposed to actually getting these money back plans, because the economics almost never make sense. You never make enough money from these products where that money back component is actually worth the effort, worth paying the extra premium today. So if you are buying a term insurance product, please don't fall for this money back trick. Just buy a product that does well for you. The last thing that I want to focus on when you're buying a term insurance product is, if you are focusing on buying a good insurance policy, know that with life insurance, 99.8% of the time, you're probably going to get your claim, unlike health insurance. Health insurance is something like 80-90% for a very good plan. But with term insurance, you're always going to get your money, right? If something happens to you, they are going to pay out. So if you are buying a good term plan, the only things that you should focus on, most people, as they would say, is a claim settlement ratio. If it's very high, it's good. The second thing is, you should focus on seeing whether this company does a large volume of business, right? So it's very easy to settle 10 claims as opposed to settling 1,000 claims, right? So if there's a company that's actually doing a lot of business and they're settling more claims, then it makes sense to argue that, you know what, that's a good product to buy. So in summary, and I've taken about 10 minutes, I hope that that's fine. What I'm trying to say is this: if you're planning for your kids' future, make sure that you protect your downside. You buy a good health insurance plan, and while doing so, make sure that you read some terms at least, and also make sure that you're planning a cover that is set aside for those extraordinary events, not for the 50, 60, 70,000 events. When you're buying term insurance products, make sure you buy only pure protection products where there's no investment component. And if somebody promises you money back, please tell them that you're not looking for an opportunity of that sort, because it almost never makes economic sense. And I yield the floor. So Arindam, yeah, I think that's about it for me. But yeah,
thank you, Shreya. That was a very enlightening session. I also learned quite a bit. Thank you. It was very good. So taking it ahead from where Shreya ended, so I think one good point he made was, protect your downside for your child's or children's future, right? That's very important. So if I can take off from there, we at EduFund, we like to think what we are helping you do is cash in on the upside of your child's future. So what do I mean by that? So Shreya talked about downside. How do we capture the upside? So in India, traditionally, we've always had high inflation. We keep talking about growth in India, but one thing that we've never really tamed has been inflation. And one thing that inflation does is not only eat into our savings, but also makes things that we want more and more expensive, right? It's almost like a tax. So education, right? That's something at EduFund we are very passionate about. So if you go to, the next slide, Naman, if you can just, so these are some of the, we don't need to introduce these universities. These are some of the great names, right? So one thing that inflation has done, right, especially in India, is make the cost of education pretty high. So, while some of these are foreign universities, what inflation does is make our rupee weaker, and a weak rupee makes it more expensive to buy things. So, for example, Harvard, that cost of undergrad in Harvard is about 2.8 crores at today's exchange rate. IIM Ahmedabad is, I think, roughly 24-25 lakhs. ISB is, I think, around 40 lakhs. Princeton is about 1.6 crores. So now when you take these numbers, right? I mean, these are staggering numbers, right? And I think it's very hard for a parent to see that his child has gone through the entire grind and got admitted into some of these world-class universities, and then tell the child, look, boss, we never saved enough, so tough luck. You will have to find another university. No. And while student loans are available, right? I mean, that's a part of the business that we do. But remember, it's also pretty hard to get a loan. It's not as easy. And remember, most of us, when we do our undergrad is a defined event. So that means you are going to go to college at the age of 18 or 19. That's what we mean by a defined event. The only thing that is ambiguous is what college you will end up in, what you may probably study. That is the ambiguity. But most of us in middle class India, we are going to go to a college. So how do you prepare for something which is a defined event? In my view, we take help of the equity markets, right? I mean, and look, India has, the equity markets in the last 10 years, they've done reasonably well. And the one thing that has changed in the last, I think, 20 years to now, you've got mutual funds that has really come up as a very powerful saving tool for middle class. When my father saved for me to study abroad, mutual funds were not available. And the directly participating in the stock market was very risky. And it was also unregulated. So today markets are a lot more regulated. You have mutual funds which have a very good track record, which is basically the past performance, and 12, 13, 14% return on an annualized basis is available without doing some crazy risk. So this is very much doable now. And which basically means even if you start off with like a 10,000 rupee SIP over 10 years with a 12, 13% rate of return, you are saving yourself quite a generous amount of money, right? I mean, I think you can easily do 18 lakhs, something like that. So these numbers, right? And suddenly if somebody says, I need 18 lakhs, that's a large number. But remember this journey to 18 lakhs, to 20 lakhs, to 25 lakhs. If you have a 10-year period, it's not very hard to do it. It's not very hard. And how can you do it, right? So there are funds. There are obviously a lot of mutual funds available. India has about 5,000 mutual funds. And what we offer, we are a SEBI-regulated platform. What we offer are direct funds, which also gives you this extra advantage of no cost. There's zero commission, nothing. So when you put in 100 rupees, your actual 100 rupees gets invested in the fund. And the entire upside is yours. And again, the idea is, you have a defined event, which is your child's education. Whether you study in India or abroad, quality education has a cost. Yes, somebody will give you a loan, right? But if you have a 10-year period, why not reduce the burden? Start on a savings plan, stick to the plan, do systematic investment, and then whatever is the difference, obviously you can go for a loan. But savings has to be at the core of this journey. This is what we believe at EduFund, and we have put together a platform for all the direct mutual funds. So please take a look at what we offer. We also have a college cost calculator, which I think is a very unique feature that we offer, simply because it helps you see and visualize what is the financial burden that you will incur. A lot of times we don't save because we don't realize the problem that is staring in 5, 10, 15 years. My own university, undergrad university, the cost of it has risen by over 2 times in the last 20 years. I never knew it till I was myself surprised. So I played around on the calculator and I was shocked how much more my own university. So again, we don't imagine problems until we see them. So it's very important for you to see the cost and then start on this savings journey. So that's it from my end at EduFund. So yes, as you're protecting your downside, make sure also to participate in your upside. And that's what we brought together today with Shahid as our participant. And thank you everybody who came in. Thanks a lot. So we are open to questions. Anybody has a question, please feel free.
Thank you, Shahid, and thank you, Arindam. That was lovely. We have a couple of questions which are trickling in, and I believe this will be better addressed by Shahid. So they ask, this is Rachna, she asks, which type of health insurance plan is right for expecting parents?
Okay. So that's an interesting question. And while it's very hard for me to recommend a plan per se without knowing the specifics here, I can give you some pointers on how to think about it. Now, expecting parents almost always think about their kids, right? So listen, one of the most perhaps stressful and joyful event at the same time is childbirth, right? So one of the things that you'll probably be considering right now is maternity costs. However, there is a pitfall here in that if you buy a plan, health insurance plan with maternity included, you would think that that's a good solution because look, if you are going to the hospital right now, if it's a tier 1 city, you'll probably be spending anywhere between, say, 50 to 80,000 ballpark figure, in the process itself. So you're probably thinking, oh, listen, how about I buy an insurance plan which also offers protection for childbirth events, so that I don't have to worry about costs during childbirth. It makes perfect sense, right? You can save 80,000, and even if you pay say 15-20,000 for a good health insurance plan, more often than not you won't. If you're in your 30s, you probably have to pay somewhere around 10-15K. But let's suppose you have to pay it. You'll think that that's a no-brainer. That makes a lot of sense. Unfortunately, there is a problem with this logic here again, which is what I was talking about earlier. You have to read the terms and conditions very carefully. See, if you know for a fact that you're expecting, right, and you want to buy a plan with maternity, the insurance company also knows this fact. So what they're going to do is they're going to put some restrictions so they don't have to pay out 80,000 rupees to you during childbirth and only take 15,000 in premiums, right? So they'll have some equation there. So what do? Well, the first thing is they'll put a waiting period. So if you're expecting, say, in the next 1 or 2 years, know for a fact that most health insurance companies that offer you maternity plans, that offer you maternity benefit, will not extend protection for at least 2 or 3 years, right? So usually they'll have a 3-year waiting period. So they'll say, we're not going to pay anything. After 3 years, they'll tell you, we will cover the cost, but there will be limits. More often than not, they'll tell you for C-section, we have a limit of about 30,000. And for let's say not C-section, normal delivery, you'll have 30,000, C-section, you'll have 50,000. So you'll get some protection, but not complete protection. They'll also tell you that if you want to buy one of these plans, what you have to do is you have to include your husband in the policy as well, include your spouse basically. So effectively, both of you are paying for a plan where you have maternity benefits, but only one of you will ever claim maternity benefit. So it doesn't always make sense to buy a plan with maternity, although that's the first thing you'll be looking at. The second thing that you should know is, okay, so if I'm buying a health insurance plan, then should I just buy a regular health insurance plan without maternity benefits to save costs? May not be the answer, because more often than not, one of the things that you have to worry about is complications during childbirth. If your baby, for instance, God forbid, has issues, right, complications, insurance companies don't cover those costs at least for the next 90 days. Then they will include your baby free of cost, even if you don't have a maternity benefit, and you can pay the premiums the next year, right? So it doesn't matter. But those 90 days are very crucial for any child. So if you want to cover those costs, if you're protecting for those, then my suggestion is to actually buy a health insurance plan with maternity included, so that you don't have to worry about those complications. But if you are tight on cash right now, you might as well say, you know what, I'm just going to buy a regular health insurance plan. I'm going to include my spouse in it as well. And hopefully when I have the kid the next year, I can include my child as well. So there's no problem, no issues, etc. If you want specific plans, if you want to know what plan to buy, I think we'll have to know more details. One of the things, so we run Ditto. You can just maybe visit the website, book a call, talk to one of our advisors, and they'll tell you precisely what plan to buy. But this is the general idea when you are sort of buying a health insurance plan and you're expecting.
The question is how to consider the decreasing value of rupee plus inflation while planning for 10 to 15 years.
Sure. So traditionally, if you look, at our inflation, it has pretty much stayed between 5 to 10%. Sometimes it has even gone above 10%. And what it does, it kind of, if you look at these are all published data, rupee has depreciated at around 4.5% per annum for the last 10 years. So what we have done at EduFund, this college calculator has been made using this data in the back end. And because India is now structurally doing better as an economy, foreign fund flows are very strong, we've taken this 4.5% depreciation and tweaked it to 3.5%. So we've given some benefit of doubt to the larger economy that we have now, a more structurally better economy we have now. But what we keep doing is every 6 months, we keep looking at our back-end engine and we keep adjusting the currency. So if anything drastically happens, positive or negative, it is adjusted in the price. So also the college calculator that you see, it's very dynamic. It's not a static calculator. So it covers everything. I mean, it will actually move a little up or down depending on how inflation is, how currency is doing, all of that. I hope that answers your question.
Thank you, Arindam. Shahid, we have a question for you from Anirudh, who says, can you shed some light on the profitability of the United Linked Insurance Plan?
The thing about ULIPs, for instance, does it make sense, right? Does it ever make sense for you to buy a ULIP? In my humble opinion, and you could ask this, to Arindam or any reasonably well-versed financial advisor, and they'll tell you it's a terrible, terrible choice. And the reason is very simple. ULIPs are great, they're extremely good marketing products. Like imagine if I told you, oh, you'll get the benefits of insurance and the benefit of investment, you'll jump on it. But in reality, what's happening is this. When you're buying a ULIP, right? I gave this example, but maybe I can expand on it a bit more, since you asked specifically about profitability, and I'm assuming profitability for you as a policyholder. So let's suppose you're investing 100 rupees, right? 100 rupees. Now, out of this 100 rupee, first what they're going to do is set aside at least 10 or 15 rupees, which will never get invested, right? So this goes into the life fund. So what this means is if something happens to you during the policy term, they'll give you something like, say, if you're investing 1 lakh in premiums every year, they'll probably give you 10 lakhs, right? If you die, if something happens to you. So that 10 rupee never gets invested. Then they'll take the rest 90 rupee, and out of this 90 rupee, they'll probably invest, first there'll be a mortality, there'll be administrative charges, there'll be fund allocation charges, there'll be a lot of charges that usually go along with it. So out of this 90 rupee, you would somehow assess that around 80 gets invested. So right now what's happening is you've invested 100 rupee, but almost 80 rupees is gone. It's never invested. And that 80 rupees is then invested into the market. Market as in it could be any fund, right? It could be a mutual fund, like Arindam pointed out that they're probably, talking about direct mutual funds. So my point is this. If you want to do this, you could do this yourself. So the simple example is to simply say, okay, you know what? I don't know a lot about the markets, so I'll just buy the whole market itself. And by saying I'm buying the whole market, I'm saying Nifty 50, the top 50 stocks, etc. And I'm going to buy a very good term insurance product so that if something happens to me, I don't just get a measly 10 lakhs. Instead, I get 1 crore or something like that, so that my family can at least live the next 10, 15 years without actually having to worry about the other expenses. Yeah. So in terms of profitability, the only people it's actually extremely profitable to is the insurance companies. It's never going to make a lot of sense to you, right? So if you are probably looking at something like a ULIP, right, I would urge you to do this. Buy a good term insurance plan separately, and then invest that money using advice from a good financial advisor, right? Instead of investing just 80 rupees, as I talked about earlier, you could invest the whole 100 rupees and probably compound your wealth on that 100 rupee. You can run a simple experiment. Take 100 rupee, make sure that it increases by 12% every year, compounds 12% every year, see what returns you get, 20 years from now, and then take 90 rupees and see compound it again by 12% and look at the difference. It's huge. We're talking about lakhs, right? So please don't make the mistake of probably combining insurance and investments together and buy a ULIP. If you must, like I said, you can buy a separate term insurance plan. and then invest your corpus elsewhere in a good mutual fund, or even if you want a safe product, I would even suggest an FD. I mean, it's not a market-linked product, but still, it's probably better than a ULIP. That's my opinion, at least.
Thank you, Shahid. I actually have a follow-up question on it. I think Rachna, they're asking how I can diversify my money between mutual funds, insurance policies, and then ULIP.
Right. Like I said, I would probably ask you to not consider ULIPs. And when it comes to mutual fund, again, it depends on your goals, which I think Arindam will be able to shed a lot of light on when you're talking about what are you building your wealth for. I mean, is it for retirement? Is it for your children's education, etc.? So you'll have to take into account those goals, because not all investment options are built equal, right? So for instance, you could be investing in a high risk market fund, right, where the ups and downs will be, it can be tumultuous. You could be up 80% one year and then you could be down 20%. If you're looking at a children's fund, you don't want to be in a position where you find out that, oh, you know what, it's time to commit to their education fee, but then I don't have the money because my portfolio is down 20%. That's not a situation where you have to find yourself in. So depending on why you're building wealth, right, you may have to choose different mutual funds and you have to allocate your resources differently as well. But my point is that this allocation should be independent of the term insurance plan. Like if you're buying a term insurance plan, the only question you should ask is this: in my absence, what will my family need for the next 10, 15 years so that they don't have to worry about anything else? The way most people ask this question is this. Right now, if I'm alive for the next, like I'm 28, let me give this example. I think make it easier. I'm 28, right? I have no dependents. The only dependents that I have are my parents. But eventually, I'm going to get married. I'm going to have kids, etc. Hopefully, so I want to make sure that until I have the capacity to earn, which is usually until the age of 65, right, my dependents should have the recourse to rely on my income. Even if something happens to me at the age of 35, if I die, God forbid, they should still have income for the next 35 years because I would have provided for them during those 30 years, right, until 65. So if you are buying a good term insurance plan, that's the only question you should ask. What kind of money do I need? And is there a calculation? Well, crude methods are to use your income today and then multiply it by 10, 15, 20 times. But a more appropriate assessment is to actually, do the calculation properly. Again, I could probably do it with you if I have the precise numbers, or you could book a call with Ditto. But my point is this: if you're saving, right, for your children's fund, etc., then your investment plan should be dependent on the goals. But for a term insurance policy, it doesn't matter what kind of money you allocate. The only question is this: what does my family need in my absence for the next 10, 20, 30 years, depending on where you are right now? Hopefully that answers the question.
Thank you, Shahid. I don't know, we have an important one from Abhishek, who is asking, how would it be safe to invest for my child, seeing how the market is doing right now?
Most markets, especially emerging markets, they will have a very high amount of volatility, which basically explains what is happening around, right? It could be up one day, down another day, even more down the next day. So the only way to insulate yourself from volatility by being in the market and reducing the risk on your portfolio is to know what goal you're planning for, how far is that goal, and aligning to asset allocation as per that goal. So what does that mean? Let's say if you have a 5-year-old child and you're saving for college, that means your child will not be in college for the next 13 years. In that case, you have a massive runway. 13 years is a lot of time. Start buying risky mutual funds or high growth mutual funds, which obviously have a higher component of risk. What it does is it will help you chase those returns, right? However, if the market was to fall 5% tomorrow, does it really matter to you because you need money after 13 years? No, you should be aligned towards higher growth and slightly more risk in the initial part of your journey. As your journey goes towards the end, or as you keep coming closer and closer to the target, then the goal should be to protect all the good work that you've done, protect the corpus, then start reducing your exposure to risk. So that means moving to index funds, moving to maybe a hybrid fund, moving to a maybe very close to the event. You may also be just in a debt fund, just GSEC, government securities, which is. So this is how you manage your investment in spite of volatility, because volatility will be there no matter what. Right now, you've got Ukraine, Russia war going on, and volatility is because of that. Next year, it could be something else or something else. So you cannot be in a market and hope that there is no volatility. You just have to plan for it.
Thank you, Arindam. We have another one for you. Sanjana is asking, my son is 17 now, and she wants to know what kind of funds she should now invest in.
I would say because the market has corrected so much, right? I mean, this is a good time to enter the market, and you should buy probably an index fund. Look at the Nifty index fund. We have some on our app, or all of them are on the app. You can buy any. You can buy an HDFC index fund, Navi index fund, doesn't matter. You can buy an index fund which gives you the ability to buy the entire market. It's like a basket. And I think you can also buy a mid-cap fund, because again, a lot of valuations have come down in the last 3 weeks. So this is a good time to enter. So you can balance yourself and chase some growth using index fund, a Nifty index fund, and a mid-cap fund. And again, I would urge you, when you choose a mid-cap or a small cap or a balanced fund, look at the track record. That means see how that fund manager is doing, how that fund has done. And if you come on the app, you will see all these funds. We have got the 1 year, 5 year, 3 year, 6 month track record. So you can actually see which funds are doing well or better over a long term, and you can actually buy those. And again, one last thing I would point out, I mean, for most of us, it makes sense to buy direct mutual funds simply because you take out the 70 basis points or 70 paisa commission, which is added to your return. And over a long term, it matters a lot. 70 paisa over 10 years is a lot of money. So don't lose that in commission.
Thank you, Arindam. I request you to take one last question for the day because it's a fairly popular one in terms of there's some people who are worried. So the question is a mutual fund safe? And I know you've answered it in different ways, but we'd still like you to address that. Thank you.
Sure. So when we talk of safety, so if you mean that will I never lose money in mutual fund? No, I don't think anybody can make such a blanket statement. Yes, so you can reduce the risk. So number one, mutual funds are regulated by SEBI. The market regulator looks and regulates mutual funds. Funds have to give declaration, which makes it a little bit more transparent. However, to further reduce your risk, what you should do, instead of just buying blanket any mutual fund, you should look at the track record of mutual funds. How are they doing? How have they done recently and in the medium past? And the last thing is, you should also be aligned to funds which make sense for your goal, right? Again, if you want to be in the market for 15 years, you can be in a high growth, higher risk fund. But if you only want to invest money for 6 months, don't be in a small cap fund. Don't be in a mid cap fund. That again increases the risk. So when we talk of our mutual funds safe, yes, they are safe, provided you, also align the fund to your investment journey and look at the track record, buy larger funds, and yeah, they are reasonably safe instruments. I think they are, in fact, more than safe. I would say they are one of the friendliest instruments to invest and create wealth for a retail investor.
The question is, are there any mutual funds in which we can increase the SIP? It's from Shasha.
Sure. Again, if you already have mutual fund investments going on, try to top up those current investments, or look at a small cap fund, right? In the current market, they have a lot of them have come down to very good valuations. You can create wealth over a long 5 to 7 year period. Look at small cap funds, look at a mid cap fund, and even look at the index, Nifty index fund. So these would be some of the themes of investment or mutual fund investment to look at. Thank you.
Thank you, Arindam. Please reach out to us for any questions. We will all be getting a follow-up email with the webinar recording. So please share it within your friends and family. Again,
thank you, Shreya.
Yeah, thank you.
Great hearing your views on insurance.
Yeah, no, thank you. Thank you, guys.
Thank you.
For
Thanks.
having
And
me.
I mean, all the points you made about ULIP, they are so correct. Yes, it's
Yeah.
always better. Yes, yes.
Yeah.
Thank you. Thank you.
Yeah.
Talk to you soon. Bye.
Have a
Take
nice
care.
day. Bye.
Thank you.